We thought of starting a newsletter that talks about our focus areas, which is fintech, health, and climate. The idea is to share important developments in these sectors and the broader startup ecosystem. This week, if you're not living under a rock, you must be aware of the Paytm and Byju's saga. But those stories have been done to death, and we have nothing useful to add. A slightly more interesting story was the comments by a parliamentary committee on the issue of concentrations among UPI apps. Here's a quote from a report by the parliamentary committee. But why is the government concerned about the concentration of UPI transactions? PhonePe and Google Pay account for 83% of all UPI transactions. The majority owner of PhonePe is Walmart, which is a US-based company, and so is Google. The government wants more dominant payment apps that are homegrown. But why really? In 2020, NPCI had imposed restrictions on the total volume of UPI transactions processed by a single app at 30%. UPI apps like PhonePe have a market share of above 30% and had time until 2025 to comply to this regulation. When NPCI announced the move to cap market share in 2020, insiders and industry observers were left scratching their heads. How would an app go about complying with the regulation? A hypothetical solution was another app to gain market share, but that hasn't happened yet. Since UPI transactions are free, building a standalone UPI app today will also require one to conceptualize revenue channels for the app. The government had announced an incentive scheme to be split between RuPay debit cards and small UPI peer-to-peer merchant transactions. Paytm was able to get a part of this incentive since the Paytm Payments Bank was acquiring all of its UPI transactions. Other UPI apps without a captive bank got nothing. Large merchants offering their own UPI integration within their app creates a challenge for new standalone UPI apps. While it benefits customers and aligns with UPI's standardized experience, it eliminates the key differentiator for new apps. Will PhonePe and Google Pay begin rejecting transactions in 2025 to comply with the regulation? Only time will tell. Both developed and developing economies are witnessing increased concerns over market concentration in various sectors, leading to stricter regulations. Financial regulators have become more assertive, exemplified by actions like China's Ant Group crackdown and India's UPI market share cap. This shift away from light touch approach suggests a growing global trend towards regulating companies, especially fintechs, to removing opportunities for regulatory arbitrage. We thought we'll stay away from the Byju's news, but we are going to give you just a little bit of Byju's and only the interesting aspect. By now, you would have read the news that Byju's lost 99% of its valuation and is looking to raise $200 million through a rights issue at a pre-money valuation of $20 million. Startup investments are risky, and investors try to have some clauses to lessen the damage if things go south. If a startup raises funding at a lower valuation than its previous round, it's called a down round. Down rounds are bad for investors because the value of their investments fall. To protect their investment value in case of down rounds, VCs can have anti-dilution clauses in shareholder agreements. These are two types of anti-dilution provisions: full ratchet and weighted average. Here's how ChatGPT explains it. Apart from this, the broader VC world is seeing an extended winter. VC distributions, or the money they are giving back to their limited partners or LPs, seems to have hit a 14-year low. You can check out this graph. If LPs don't get back money, they can't reinvest, which makes the life difficult for some VCs. So far, everything we have spoken about is a condensed version of a newsletter we have recently started. You can check out the newsletter in the description.